Hello and welcome to Weekly Market View. I'm joined again by Bill Hubard. So Bill, interesting couple of weeks in the market, but still a little bit undecided. Yesterday obviously a sell-off on the back of the fear that the easing is going to end, certainly the other side of the water. What are your views of the market?
Well, let's go back to a word you just used, fear, okay? I break that word down to false expectations appearing real. And I think the market has totally misread, totally misunderstood what Chairman Bernanke said on the 22nd of May. He said, yes, we will consider paring back or tapering quantitative easing if, and I capitalize if, the U.S. recovery continues to improve. Now, he told us, remember back in December, that had to be 6.5% on the unemployment rate, and on the other side, concerned about inflation being 2%. I feel that the market totally misread, misunderstood. We may not get the clarification until next Wednesday, when the Federal Reserve finishes their next June two-day meeting. But I mean, it's sort of like, and I'd love to say that I coined this, but I didn't, but my good friend Uncle Al Greenspan did. You know, we had total irrational exuberance in the stock markets on the way up in the first quarter, and the bond markets, again, with the quantitative easing. But I mean, and I apologize since we've had at least $2.5 trillion wiped off all the global stock markets. But it's been rather silly. It's been ill-placed, I feel.
I mean, certainly we're getting that kind of picture from our book on the desk. We've obviously moved from what 5,800 to 6,800 the FTSE over a fairly consistent rally. We pulled back to 6.3 at the moment, and the book is a bit undecided. You know, they can't quite seem to make up their mind whether this is the chance to buy into the dip or whether it's the start of a good, as you said. I don't know, you coined before the old 7 May.
Yeah.
Which obviously and
it's quite that you say that, because I feel that maybe the hedge funds got their calendar wrong. And I think what we're seeing is, and I think this will continue, selling in June and July, and will come back after the school holidays. And I think that's what we're starting to see, because whether it started with the gold situation, people redeeming gold, or this, that, and the other, but that is where the big money seems to be coming out of, all the hedge funds, massive selling, and the money going back into the money markets, getting a negative return, which they took out in January, February, and March.
Now, so the gold doesn't seem to be much of a story now. I'm still sitting around 1,400, but there is quite a lot of talk out there about the bond bubble.
Yes.
What do you make of that? I mean, is it, you know, you said before about how low interest rates, how much can they go?
Well, I think it's a situation where, if you want to look on what they call option-adjusted spread. Now, when we reach 2.29% on the 10-year, okay, and this is all implied in swaps and in futures market. Now, 2.29% does imply a tapering to begin, and this, as I say, implies probably sometime in late October, early November, okay, which would probably go along with the December meeting. Now, we're below that now. I think we're like 220. But my feeling is, and this is where we've gotten totally irrational, okay, the day before the Bernanke comments in May of last month, was Fed fund futures were implying the first rate hike by the Fed would not come until the first quarter of 2016. Okay, we have now moved 50 basis points, okay, in less than a month. Now they're saying the first rate hike will come in February of 2015. Now, that is an absolutely meaningless number. So, because where are we going from? It's not like going from 9 to 9.5 to 10. We still have a negative interest rate. And my personal feeling is, we got retail sales today from the States. A good number, 0.6. But again, if you want to imply something, we would have needed something like 1.5% retail sales to give the market the feeling that the consumer is spending, the consumer is confident. And the simple fact is that we're not going to have the tapering. All right, let's go back to yesterday. Here in the UK, yes, we got another positive unemployment number, you know, but it was only, you know, 5,000, although I guess RBS, you know, wasn't in that number. But all right, look at that, okay? That was a good number, shows that employment level has dropped. What was the wage number? I think it's 1.3%. I mean, it's like wages are the lowest, they've been in 25 to 30 years, which to me implies, I don't care what I'm being paid, as long as I've got a job. Fingers crossed that I'll have this job this month, next year, when the economy starts to improve, and so that it will keep me on. And we're seeing the same thing in the United States. I mean, we saw it last month. The unemployment rate went from 7.5 to 7.6 because like 460,000 people decided to come back into the employment market, hence the reason it ticked up. But the Fed has already told us 6.5% is the level. And I think one of the things that maybe some of our viewers may not fully understand. Remember, the Federal Reserve is 13 Federal Reserve districts. And that's what you have to look at. We get a much better clue on the beige books, which of course is reported every month that there's an FOMC meeting, and they only meet 8 times a year. And that's what we really need to know, because where the Fed will look, and we will get back to days when the Fed will have interest rates at 4 or 5%. But the key is we want to know it's not the U.S. economy. Chicago may be okay, but Dallas is not. San Francisco's neutral, but Philadelphia's not doing anything. Hence the reason when we look at the regional ISM, this is what the Fed looks at, okay? Now, we get a slight feeling here with the agent's report for the Bank of England. And of course we get nothing out of the European Central Bank. They probably don't even know where Slovenia is. But I think that's one of the things that you're looking at, okay? Like today with the retail sales, or the case Schiller. Okay, that has 20 major metropolitan areas. So what you're starting to see, that will give you a regional clue on how the whole United States economy is going.
Okay, so we're talking about the whole United States, the whole European states. I mean, Eurodollar, I saw that was making new highs around 134, I think it was this morning. Yeah. What do you make of that? It seems a bit odd in the backdrop of some of the unrest going on.
Well, I think one of the things, and again, you advertise, markets.com, we advertise that we do, 50, 60, 70 currency pairs. Well, I don't know how often you guys trade the Zimbabwe dollar against the South African rand, but the currency pair you're going to trade, euro dollar, Japanese yen, cable, etc., etc. One of the things that we've been seeing is because of the concern in, let's say, the emerging markets of Central Europe, we've been seeing, the Polish zloty, the Czech krona. I mean, the Czech krona fell like to a 3-year low a couple of weeks ago against the euro. And also, you see, remember, these currencies, look at the flooding we're having. Hungary, Poland, Austria, even in Germany now. So you're starting to see a lot of that selling, which is supporting the euro. Okay, so if you're an algorithmic trader, this, that, the other, all of a sudden, you're seeing the euro rise more against selling of some of the Central European emerging market currencies, okay, which is boosting the euro. So then they say, well, the euro is rising, so we've got to sell the dollar. And it's also been one of these things where equities just got irrational. The positive move in the dollar got irrational. Gold got irrational at 1921. The bond market the same way. So now the question is, when do all of a sudden do we go, I'm too old for this irrational exuberance, let's get back. But one thing that I don't think we have to know, any of our viewers, be prepared, okay? All of a sudden, you may be in the bathroom the day all of a sudden the hedge funds come back, whether it be the 15th of July or the 1st of August, and all of a sudden you look at the FTSE and it's up, 400 or 500 points in a week. Because we won't get back as quickly as we got down. Because you see, all this money is not disappearing. It's just going back and, you're seeing a massive now increase in the money market funds, okay? And if and when, and as I said, I would expect in the next 90 days to see, we have a much better chance of seeing the Treasury 10-year move from 2.25 to 175, okay? Now, somebody said, well, what about 3 years from now? Well, unfortunately, the market now, where we were looking 2, 3, 6 months out, now it's, oh my God, what am I going to do between now and 2 o'clock this afternoon? So we've gone from ultra medium to long-termism to ultra, minute by minute trading. So yes, I would see a much better chance of the Treasury 10-year, 1 3/4 in the next 2 or 3 months, but we will see 3% in the next year or 2 years.
Okay.
On
Well, I like that. 90 days. I'm going to write that one down and come back to you on it. Let me finish with the story you kind of half alluded to earlier. I don't know if it falls into the irrational category or what, but the Stephen Hester at RBS resigning. Now, it seems to be everyone's darling now he's left. It's one of these funny things I saw where RBS shares were off 6% first thing this morning. What do you make of that? Are they out of the woods?
Well, I think they are, okay? One of the things, and I'm evading it temporarily, okay? Back when we had that slight problem with Lehman Brothers, and you had the Bank of England, we had a lot of rocky situation up north, okay? So we had the Bank of England, with Lloyds and RBC. Now, the US did the same thing. One of the banks they bought was Citigroup, all right? Now, the US Treasury sold their Citigroup shares. I think they made something like $43 billion, about a year or so ago. This is what we're going to have to do, okay? The simple fact is, I think this is correct. I guess it's a difficult situation, when you're chairman of the bank and the Bank of England forces you out, maybe this is not the right comparison, but I don't think Barclays Bank had any funds from the Treasury, but you could always say that the Treasury Select Committee sort of said, well, thank you, Mr. Diamond, for sure. I think, to be honest with you, I think he's done the job. I would fully agree if this happened and the Treasury said, wait a minute, we'd like a new man at the helm. It's like anywhere else, okay? It's like when the football team's not doing well, you can't fire the team, so you fire the manager. And let's just say maybe Jose Mourinho is a classic example of this. He's coming back. I think it's a positive move for the bank. What were the shares off? 2.6p? I mean, what kind of move is 2.6p? I think what you'll start to see, is that the fact is, when we know who it is, what it is, where we're going to, I think maybe this was poor planning when he announced he was leaving last night, and then RBS announced there were 2,000 more redundancies, and it may be areas that I thought they were fairly good at. But I mean, I think it's a situation where, like anywhere else, if we can start with a clean slate, where we don't know Joe Bloggs, we don't know Fred Smith, so therefore his CV is clean. I'm sure the Treasury, the chairman of the board of this, that, and the other, will make the decision based on a clean situation. I think one of the things where, and I think is Hampton, whoever the chairman is of RBS was on I think the Jeff Randall show last night, and I think Jeff Randall asked the question, will the new guy come in and have the same sort of a golden hello, golden goodbye, golden this, that, the other, that Stephen Hester had? I mean, I think the new person will come in. My feeling being is maybe we're going to have to call him an interim, chairman. He comes in and his deal is 1 or 2 years. Come in. You've got a clean slate. This is the program that we all want, whether it's working with the Treasury, the Bank of England, the shareholders, etc., etc. I think it's a situation where I don't think Stephen Hester. I didn't go out this afternoon and see him at Liverpool Street Station, but a big issue. I think it's the right move. I don't think maybe the timing was correct, and now it's all conspiracy theory in all the newspapers this morning. But I think let's get somebody in that's got a fresh outlook, a fresh idea, and it's not in any way tainted with the previous administration.
Be interested to see if he lasts longer than Mourinho then.
Yes.
Okay. All right. Thanks very much.
A real baby.
Thank you.
Thanks.